And the very first chapter is estimating the market risk measures and introduction and overview. So most of the things that we have seen in level one is something that you would see in this particular chapter. And if you've gone through the curriculum of the other chapters that we have specifically in this book, you would see a lot of things that you've seen in level one. All right. So it's quite a match of what we have seen, but with many differences in between. All right. So let's go ahead and let's start with the very first chapter. All right. It's important that we go through the basics. All right. Basics will help you to build the foundation that is needed. So there are two types of returns when we, think about finance or financial returns. So as I said, there are two types of returns. The first one is a simple return, you can say, just like a simple return, compounding return. Arithmetic return comes in the category of a simple return. Now, this approach is not exactly appropriate for a long-term investment horizon because there's going to be a lot of dividends that you're going to get. But even more important than that is the concept of reinvestment. Okay. So in arithmetic return, there is no reinvestment of the dividends that you get. For example, let's just say that you purchased, maybe let's just say that today you've purchased something right here. So this is PT minus 1. And as you move forward to maybe, let's say, a period of 5 years, okay, so that is going to be P today, that is a period of 5 years. All the dividends that you would get or any coupons that you would get, they will not be reinvested. And this is the major reason why this arithmetic return, it's a simple return. It's just going to give you the calculation of what you are getting, but without the concept of compounding or reinvestment. Okay, so that's the problem with arithmetic return. Another problem, okay, it has is that what if the price at T, that is, let's say after you purchase something at 100, a share of a company ABC, but what if at 5 years down the line, the share is now 70 rupees? So that's a negative PT over PT minus 1. PT means price at T minus 1 time. So that is also a problem with the arithmetic return. Okay, but just understand for now, just for the basics, that there are two types of returns. The first is the arithmetic return, not appropriate for a long term and does not consider the reinvestment. On the other hand, we've got something which is known as a geometric return. Here, the interim payments, that is all these dividends or any kind of things that you get in between, they are continuously reinvested. That means they consider the effect of compounding, right? And that's the reason why this is more preferred when it comes to comparison of both these things. All right. Now, this approach, they ensure that asset prices can never be negative. Even if you got this particular thing, like let's say PT, that is price is negative, okay, from what has been the overall return. Even if you take this particular thing, okay, it's going to come negative. But if you take a log of this particular number, it's going to turn out to be a positive. Okay, so that is the reason this is more preferred. And especially when we will see later in the next learning objective is that there are two types of distribution. So if your distribution, it is having some negative returns or something like that, negative prices, then no worries. You take a log of these things, convert that into a log normal distribution, and then use that in your analysis. Okay, so that's two different types. And one more thing that we're going to be actually seeing forward is the concept of data. Okay, data is something that we're going to be using, and our data can come in various forms. Okay, the source can be anything, but the simplest is that we can actually use is in the terms of profit or loss data. Okay, that means you can create a histogram of data. Okay, on this side you may have your profits, and on the negative side you may have your losses. So basically you can distribute your data in such a manner. Okay, so P&L or profit and loss data is something that you would see in this particular topic. All right, moving on to the very first learning objective that we have over here, and that is the estimate the value at risk using a historical simulation approach. Now, we've already seen what value at risk is, what it tells you about. Okay, but this is, as I said, it's a refresher to what we've seen in level 1. And there are 3 methods that we have to calculate the value at risk. The one is the historical simulation approach. Okay, the second one is the delta normal value at risk, and the third one is the Monte Carlo simulation. Okay, and if you read the curriculum, you would see that one of the core issues that you may come across, okay, as an analyst, is that which method should you be using? Okay, so the very first core issue, okay, as mentioned in the curriculum, is which risk measure should you be using? Should you be using historical or a delta normal or a Monte Carlo? All right, but nonetheless, the historical simulation and delta normal has been discussed. The Monte Carlo has not been discussed in this particular topic. So no worries. Let's start with the first learning objective, estimate value at risk using a historical simulation approach. Now, this approach is by far the most simple approach to calculate the value at risk. Okay. And in this method, what we do is we simply order return observation, whatever the returns of a company is, we just, arrange the observations. Okay, all the observation data points that we have, we arrange it. How do we arrange it? From the largest to the smallest losses. Okay, and the observation that follows the threshold loss will be denoted the value at risk limit. So as an example, you can consider that what we can do is, let's say we are looking at last 50 days data of TCS, and we want to calculate the value at risk at 1%. Okay, and or I can say other way, the 99% VAR. Now there are 2 interpretations to it. Whenever you have VAR and a very small percent amount, that means it talks about the alpha. Okay, or rather you can say 1 minus alpha, which is the significance level. And whenever you have a large number out here, that means we're talking about confidence level. I'll tell you the interpretation later, but just for now, understand what happens in a historical simulation. We first order the data. Okay, we just order it. And then we say, how do we order it? From the largest losses, and then the second largest loss, the third largest loss, so on and so forth, till maybe there's going to be 0 out here, because loss always comes on the negative side, right? And then there is going to be a break even, and then the positive numbers out here, or profits, I can say that, right? Once we go ahead and once we arrange that, then we select the n. Let's say the number, this particular data points are, let's say 1000, and the significance level is 1%. Okay, so the significance level is 1%. That means I want to find the VAR at 1%. Okay, so 1% of 1000 would be 10, right? So here in level 1, this is where we used to end up, right? So select the 10th observation first, second, third, fourth, fifth, sixth, seventh, eighth, ninth, 10th. This is my value at risk. But this was the case in level 1. In level 2, the curriculum has mentioned that you need to add +1. That is, the 11th observation will be your value at risk. So whatever number that you had in the 10th, that's not your value at risk. The 11th answer would be your VAR at 1%. Okay, that's what they mentioned in the GARP curriculum or the core readings that they have. All right, so that's
What was
one
the
way.
reason about it?
Sorry?
Behind it? So what was the reason behind it?
Well, there is no specific reason behind it. It's different authors, they're different divided. Some are actually confused at the 10, some take the average of both these things. So there is no specific reason for it. There are different authors, and GARP usually what they do is they, for example, you've created a book, right? You've written a book on finance journal or anything like that. And then GARP may take the due permission, so on and so forth, and they just simply print the material in the core readings. And that's the reason if you're reading the curriculum or if you have gone through it, you would see who's the author, so on and so forth. All right. So there's no specific reason, but yes, that's what they've suggested. That's the alpha plus n plus 1. Okay. The significance level plus n multiplied by n, because of the n was 1,000 and the alpha was 1%. So you take 1% of that and then you add up this 1. Now in Schwezer, you would see that, okay, they've not taken this 1, though they've mentioned over there. But yes, it's a good practice that what they've given in the curriculum, we should follow that. Here you would see this another way of doing the same calculation. All right. So you basically create a histogram or a distribution like this. You arrange your data from the negative, the largest loss, to the positive side over here. And then you just pick up a quantile. Okay. So over here, they've given an example of 5% VAR. All right. So whatever the data points that you have, you just need to take the 5% of that. Okay. So that is going to be alpha plus n. Okay. So alpha multiplied by n. Alpha is 5%. Whatever the n is, let's say 1,000, 10,000, whatever the number that we have, plus 1 to it. Okay. Now, so understand what exactly we are doing with this particular method. We have this 100% of the distribution, right? We've got 100% of the distribution. And over here, if the alpha is 5%, that means we've got to divide this entire distribution into 2 parts. The one with, let's say, 5% of the data out here onto the left, and the other one will be the 95% data points. Okay, so that's the core thing. You're just taking the distribution, dividing it into 2 parts, and that's what you're doing. If the alpha is 1%, that means over here, you'll go on to this side. So that's going to be your 1%. Okay, and the other will be 99% data. Okay, so that's simplistically what you're doing. And remember, VAR is always a one-tail test. Okay, it's always a one-tail test. You're looking on the losses, and losses will come on the left-hand side of the distribution. Okay, so that's something, the very basics of value at risk. Now, moving on to the next learning objective that we have, and that is the estimate the value at risk using a parametric approach for both the normal and the log normal distribution. Now, as I said, historical is something that they're focused on, that, okay, do this particular thing and overall take alpha into n plus 1 and you're good to go with the historical simulation. But in the next learning objective, they've touched upon the parametric approach for getting your value at risk calculations. Now, as I said, parametric means that you are using some sort of a parameters to estimate your value at risk. Now, the parameters in our examples that we're going to be seeing is the mean and the variance. Okay, in a distribution, you have mean and variance. Your work is sorted. You can use that and you can make some analysis out of that. All right. So they've touched upon this, the delta normal approach. Okay. And this in the parametric, we are explicitly assuming a distribution for the underlying observations. Okay. So the first thing that we're going to be looking is the normal value at risk. Now, basically what happens is that you are interested in getting the value at risk number for a particular stock. You take the distribution, okay, and you take you draw a distribution and it looks like a normal distribution to you. Okay, so what you can do is you can use this normal value at risk because you've got a distribution which looks normal. You've got the mean, you've got the other parameter which is variance. Use this for getting your value at risk calculation. Now, what's going to happen if you get a distribution that's pretty much skewed? Would you be using this normal VAR? No. Then what would you do? Okay, we'll talk this in the next learning objective. If the distribution is skewed, or maybe they've got a high peak, fat tails, there is high kurtosis, what would you do with that kind of a distribution? All right, so this is the topic for the next learning objective, but make sure in normal VAR, we are assuming that there is a normal distribution. And that's the reason why we are using this normal VAR. Okay, so when do we use this? VAR for returns that follows a normal distribution, we use the normal value at risk. And the VAR cutoff will be in the left tail. As I said, VAR is always in the left tail of the distribution. That's where you see the losses and that's what you report it. All right. But when you report this number, or even on the left-hand side, when you report it, you never say that, okay, though you got a loss of, let's say, $30 million, you never say that, okay, it's going to be negative $30 million. Nothing like that. Okay. You tell your boss that, okay, the VAR is $30 million and they understand it like implicitly, or it is very much implied that this is a loss amount. It is implicit. All right. So that is why when we are using the data that we have, that's the basic that I told you, the data is in the form of profits and loss data. So in that situation, what happens? We'll look into that. Okay. And that's where the formula is. So when it comes to normal value at risk, the VAR cutoff will be in the left tail of the returns distribution. Hence, the calculated value at risk is negative, but it is typically reported as a positive value since the negative amount is very much implied. Okay. So moving on to the formula that we have here. This is the formula to calculate the VAR at the alpha, the significance level. And that is equal to, now over here, you just see the P&L data is something that they've given to us. Okay. So assuming they've given you the P&L data, and if the data is in the profit and loss numbers, that means not in a percentage. Okay. They've given you raw numbers. So they'll give you the mean for this distribution. They'll give you the standard deviation for this distribution, and VAR is always on the left tail. So there is a critical value for the alpha that you're given, right? You take up this thing and you calculate your VAR, or rather we can say it's a normal VAR. Okay. That's one thing that you can go ahead and you can do that. Make sure that they've given you a negative. Do not forget about this negative. Because of this implicit negative being implied, we take this thing. In level 1, we studied a different formula. There was not a negative number. There was a simplistic, like if you want to calculate the VAR, mu plus Z critical value, Z of the alpha and the standard deviation. But over here, we are taking a negative sign because of the implicit assumption that we are using. Okay. So that's the reason what we have over here. And there is a variation to it. And the variation is, let's just suppose you're not given this P&L data. you have a returns distribution. The returns, when you calculate the returns, you've got that. And specifically, normal var is ideally used in arithmetic returns data set. Okay, so when you have a returns data set, then what you do is you are given this returns out here, as you can see. So the returns distribution, that particular distribution mean you're given, the standard deviation you're given, and then you calculate the z critical values for the alpha that you are asked. For the var, if it's 1%, then you need to have the z or the z value. Look into the table, get the 1% z value. Okay, and then multiply by the portfolio amount, because since this is a percentage amount, it doesn't make sense to quote the value at risk. Okay, you're gonna have a loss of 5%. 5% on what? So give me an amount, right? So that's the reason we multiply with the portfolio amount, and that too the initial portfolio t minus 1. Okay, what we invested at this point, not after what we have after 5 years or 2 years or whatever the time is. All right, so that's something that we have it over here. Now you don't have to, go ahead and look each time the z values where I've created out here, and these are the very common one tail z values that we have. So var at 5%, mostly you would see this. Var at 1%, mostly you would see this. 10% is rarely calculated. Okay, so var at 5% is 1.65 onto the negative side. Okay, this is 2.33 and this is 1.28. So these are the value at risk numbers for a one tail z values. So you don't have to, go ahead, go to the z table and find that. Okay, fair enough. So this is what normal var looks like. Let's take the example out here, and let's just go ahead and to enhance our conceptual clarity, let's just take up this particular thing. So here we are given the profit and loss distribution is normally, so we are given the P&L distribution. Okay, the P&L data that is normally distributed with an annual mean of this. We've got the standard deviation of $10 million. Calculate the var at 95% and 99%. So what we need to do is we need to calculate the var at 95, or I can say the alpha is 5%, right? So that is going to be so if I bring the formula, the mean, the minus mean, okay, plus the z of alpha standard deviation. This is something that we have it over here, and it is a P&L data. Okay, so we are given this P&L data out here. So what is the mean of this thing? The mean is $15 million. What is the z value for this alpha? We just saw it's 1.65 multiplied by the standard deviation, which is $10 million. Now, once you solve this thing, you will have an answer for value at risk. Okay, or rather I can say normal var at 5%. Okay, so this is something that we have. Anyone wants to try and wants to give me an answer, that would also be fine. Okay, so that's the var at 5%, and we've got something at var at 99. That means 1% alpha. So that is going to be the same 15 million plus 10, and we need the z value for 1%. So what is the z value? I just wrote here 2.33. So that is going to be 2.33 multiplied by 10. Now, on the exam, do you think such questions may come? Yes, there is a high possibility that you may see these things on the exam. Expect 1 or 2 questions from this particular chapter, because it introduces to the concept of normal, log normal. They've got the expected shortfall, and this is the major risk measures that we have in risk management, right? So it's very crucial, and you're going to be proficient in calculating these kind of things. Make sense? Now, let's just go ahead and let's just visually we see this particular thing, what it's trying to tell us. A portfolio has a beginning value. So it understand they've given you a beginning period value because P T minus 1, what we originally invested, that's what the value at risk or the normal VAR will be on. The arithmetic returns follows a normal distribution, fair enough. Now they've given the arithmetic returns as well with a mean of this and a standard deviation of this. Calculate VAR at both this 95 and 99% confidence interval. Now again, it talks about the VAR at 5% or maybe, so you just take the mean of, it's a return, the arithmetic return, plus the Z for the alpha, which is 5%, 1.65 multiplied by the standard deviation. Now it's a simple plug and play. You're given the returns, take 0.10, 10%, sorry, 20% is the standard deviation. So it's going to be 0.20 out here. It's going to be 1.65 for 5% Z value, right? And the mean of this return is 10%, that's 0.10. So once you solve this thing, okay, multiply both these numbers, you get a number. So minus 0.10 plus whatever the number that you get, let's just say that you got 0.45. Okay, assume that. So just take minus 0.10 on your calculator plus 0.45. Whatever the number that you get, that is going to be your value at risk. Now, within this particular frame, okay, we know it's a simple plug and play. We can expect this, yes, why not? But what about the interpretation? That's very important. That's very important, okay? So what I've done here is that, okay, so this is the formula that I've created. We've been calculating these value at risk. All right, so we calculated the VAR of this particular thing and we got an answer of, let's say, $10 million. And we report this to the concerned team or department. Okay, fair enough. And the interpretation is like, okay, there's going to be a 10 million loss and there's going to be at 1% minimum, it's going to be 10 million loss, so on and so forth. Now, two things. What is the interpretation of VAR at 1%? What if you solve entire thing, the answer comes to negative 10 million? How will you report this? How
Is
will
it
you
gonna profit?
Sorry?
If it's negative, it's gonna profit?
It is going to be profit. But I think I've got a very good question on this. And that's the reason I focus on the interpretations of VAR.
But I think it's the same thing.
No, it's not a same thing. See, we are using the P&L data. Okay, we are using the P&L data. And if your VAR is always, see, usually right from level 1 till level 2, what we have done is we have calculated the VAR and it was always a positive number. It was always a positive number. And we said that, okay, this is the maximum loss amount. I'm reporting the loss amount. Others used to understand, okay, it's a loss amount, it's a loss amount. But now, what if the number that you calculated using the normal VAR, what if the number is negative $4.5 million? How would you report this? It's a profit situation. If this positive number is a loss situation, then this negative number, it's a profit situation for you. So rather than, that means loss is nowhere. It's a good thing. If you get something like this, it's a very good thing, right? So that means you cannot have a loss on this thing. Now, take it slowly. Let's try to interpret right from the very basics what we saw in level 1. Okay, so we've got a risk manager and he calculates the 99% VAR, or I can say VAR at 1% alpha. He calculated at something around $5,000. Okay, so now there are two interpretations to it. First one, second one. I can say it in a confidence level that I am 99% confident my 1 week or my normal VAR will not exceed this $5,000. That means if I create like this and I get my VAR here at 1%, that means 1% and over here there is 99%. So this 99% becomes my confidence level that, okay, I'm confident it's not going to go beyond this 5,000. Absolutely. That's my maximum loss. And I'm confident. Yes, 99% I'm confident on that. But what about this 1%? What about this chance of 1%? So there is a 1% chance that the loss will go beyond 5,000 or even more. How much? I don't know. But that's a minimum loss level. So you can understand minimum loss. Whenever you have something in this VAR at 1%, VAR at 5, VAR at 10, they are your minimum loss. It can go beyond, yes. And that is the reason we have got some other risk measures as well. Otherwise, VAR would have been perfect. But due to this 1% room for error, we can say that, yes, there is a 1% chance and it's a minimum loss. But how about the same thing? Okay, and that is what I call the alternate interpretation of VAR. Suppose when we have profits, the example that I gave you, you calculated the normal VAR and you got a profit. That is a negative number. It implies a profit. Now, both the minimum loss, that is this, and CI is the confidence interval is actually reversed. That is going to be a reverse kind of a situation. So your confidence level will be, I'm 99% confidence that the maximum profit, ideally it should come here profit. Okay, it's not a loss because we found the profit. Profit will be at least 5,000. Over here, there was maximum, but now here it's at least. And over here, there was exceedance, but it's going to be less than the amount. And that is the reason I got this particular question from the book itself. And if you read it, the interpretation will be very much clear now. Let's take this. Assume the P&L data is given to us for this particular company. The data is normally distributed. That means it's talking about normal distribution or normal VAR with an annual mean of 20, standard deviation of 10. The 5% VAR is calculated and interpreted as which of the following statements. So let's calculate the value at risk. You've got the mean of a return, then the Z of the alpha, and then the standard deviation of the return as well. No problem. So it's a normal VAR that we are calculating. What is a mean? The mean is 20, right? Sorry, it's not a return, it's a P&L. Okay, the mean is 20, the standard deviation is 10, the Z value, what is the 5%? It's 1.65. Now, if you just calculate this minus 20 plus 1.65 into this 10, it's going to be 16.5. Now, if you just calculate this thing, it's going to come to negative 3.5. Now, what is this negative 3.5? How do you interpret this thing? It's a profit situation. It's a profit situation. That means the 3.5, that is, so your profit is going to be less than 3.5. And what is the minimum loss? The minimum loss is 5%. Okay, the minimum loss level is 5%. So first of all, is it a loss or a profit? It's a profit. Okay, no problems. So we can take this out. A is out. This is also out. Now we are left with B and D. So 5% probability of earnings at least this, or 95% of at least 3.5.
D.
So Yeah. So yeah, by looking at this thing, we can clearly say that, okay, it has to be D. But the interpretation of this, where it came from, is from this. From a loss, if you convert that into a profit, the interpretation changes. And that's the reason I quoted right here, so that if you want to read it next time, you will have for the exam, you don't have to be confused. So this is the 95% probability that the earnings will be at least minimum. See, now it has become a minimum level. Minimum, it's going to be that. Otherwise, beyond 3.5, definitely, I'm sure it's going to happen. But 5%, it's going to be between or less than 3.50. Just like over here, the loss will go up or more, but now it's going to be less than that. So just remember this particular interpretation. I think that's going to be less confusing, I would say. Rather, over here in the normal losses situation, it's going to go up. If it's a profit, it's going to be less. That's it. Even if you remember this, you're good to go for the exam. Make sense? Okay. So that is something that we have in the interpretations and the normal value at risk. Okay. When do you use this? When you've got a normal distribution, when the arithmetic returns are provided to you on the question. Then what if, let's just suppose you calculated the returns of TCS, okay, and on any company that you like, and you got a, let's just say any ABC company, and you got a fat-tailed kind of a situation and pretty much skewed data. Now, can you use the normal distribution, a parametric approach, the same mean, standard deviation? Would you be able to use this? No. In a normal situation, no. Then what do? You've got a returns that are skewed, that has lot of kurtosis. Is there any way that can we do it? Or maybe the returns that you have is very negative, or the prices are very negative, right? So what can be the situation in that? Well, one improvement that you can actually do is, for each number on the data points that you have, just take a log of that. Log of this first number, the log of this number. When you take a log, the natural log of all these numbers, it's gonna, the interesting thing is, it's gonna become a normal distribution. It's gonna become a normal distribution. So that is the reason why we are using this log normal value at risk. We have effectively, we've converted this originally skewed, high kurtosis, fat tails, and we've converted that into a normal distribution. Now I can use the mean and the standard deviation, and I can just plug it into the formula. But hang on, it's a normal, or rather it's a log normal. So there is a difference in the formula. But at least I hope that you have an idea as to why are we using this log normal? Why does it make sense to bring that on? Because obviously,
Sir,
yeah, go ahead.
sir, I have a doubt. Like, if we take the log normal of all the values, then it will give us a positive one. So how it will be a normal distribution?
See, the log of these numbers, okay, if you look at the log normal distribution, okay, log normal distribution, you would definitely feel like, okay, it starts from zero. It starts from zero and it's right skewed in itself.
Yes, sir.
Right? That's your thought process. But when you, that's actually the prices. Okay, I'm talking about the prices. So what you're saying is, this comes for asset prices. Now, prices cannot take a negative number. So in that situation, we are using this log normal distribution. But when I talk about returns, I'm not saying that they're going to form a negative number. No, I'm not saying that. But at least whatever this distribution, when you convert it, maybe it will not have any negative numbers. But if you kind of draw via the histogram, if you just draw it, it's going to resemble like a normal distribution. And that's what we mean by this. So when you take a return over here, it was -5. I know it's going to become positive. But the final distribution that you get here, it's going to very much look like a normally distributed return set. And this, I totally agree. It's right skewed, positive outliers, bounded by 0. But the entire thought process is not on this. This is for the asset prices. We know that asset prices cannot take on that. But for the returns, when you've got these numbers, you can have a distribution that may look like a normal distribution. That's the reason the natural log will return you a normal distribution. And that's what we say, that it's a log normally distributed returns. Like that. This distribution is a different thing. Like a data set may have a log normal distribution, right? So that is the thought process that you should just follow on. Okay.
Yes, sir. Yes, sir. Thanks.
Fair enough. No problems. I think you thought about that and it made sense as well. Okay. So log normal var is right skewed. As we've seen in level 1, it's bounded by 0. There cannot be negative numbers, and that's the reason income cannot take a negative numbers. But if you work in percentages, I'm not talking about numbers now, I'm talking about percentages. And that is the reason why log normal is actually used in the geometric average cases. Right? So within this 0 as well, within this 0, there can be 0.0, 0 point something. So it's going to essentially turn, ideally, it's going to give you a look of a normal distribution. That's what we can understand. Okay. Log normal, it's a right skewed, positive outliers, bounded by 0. As a result, the log normal distribution is commonly used to counter the possibility of negative asset prices, or maybe we can say negative interest rates, something we have not seen so far in the past. Okay. So that's something that we can use the log normal distribution. As I said, it's used when geometric returns are provided in the question, and this is how the formula looks like. So we are finding this var for a log normal distribution. How do we do it? We take e to the power. Okay, so if you look at the formula, we've got the same thing. We've got the mu, which is the standard deviation of the returns. See, over here, we are not given the P&L data. Even if you observe the formula, we're not given the P&L data. We're given the returns, the geometric returns. And that's why I said that, okay, this is how it's going to look like. Okay. So we are given the returns for that. The Z value, we're given the standard deviation. But one variation is there is a minus sign over here. So you have to remember this on your exam. Do not make or do not get confused when it's a log normal var. Okay, you're taking the mu, you're taking the Z and the standard deviation, and there is a negative sign onto it. And then whatever the answer that you get for this, you take the second ln, the log of this, 1 minus this thing. And you subtract it from 1. Okay. And this is something that you do it. And as I said, it's a return data. So we multiply with the portfolio amount. Beginning portfolio amount. That's what we do. So the only difference is this particular variation, I can say that. And yes, there has to be a variation because it's not a normal var. It's a log normal var. So that is the reason we have got this variation. You calculate this. So basically standard deviation multiplied by the Z value, and then you subtract it from the mean. You take e to the power, whatever the value that we have over here, 1 minus this particular amount multiplied by this. Let's take one question on this. I think this is going to help us, understand the basics. Okay. A diversified portfolio, it exhibits a a normally distributed, fair enough, geometric return. See this thing, normally distributed geometric return with mean and standard deviation of these two amounts. They are in percentages respectively. Calculate the 5%, 1% VAR. The beginning of the portfolio value is this. So it's very, so we're going to be taking the mean, which is mu minus standard deviation. Okay, so e to the power that 1 minus multiplied by the beginning amount is this. So the mu is, the mean is 10%. The standard deviation is 20% or 0.2 multiplied by 5%. That means 1.65. So you take 1.65 of this 0.2 and then you take 0.10 minus this thing. Okay. So automatically, the reason for this thing is that automatically the answer will be in a negative number, because you've got you've got 10 and you've got 20 over here, right? So you're subtracting from a short number, you're subtracting a large number. So obviously the answer will be in negative. And once you take this overall thing, the negative, it just comes out. Okay, so 1 minus this, if you solve this thing, 1 minus e to the power this, multiplied by the pt minus 1 is 100. You take this up, you'd be able to get the log normal VAR. If you're doing it right now, that's fantastic. Okay, the other way that you can, the other thing for the 1%, it's nothing but this 2.33 is replaced out here. You solve, you multiply these things, you take this particular entire value from this thing, you take e to the power. How do you solve this particular thing is, on your calculator you will have second and then you press ln. You will get e to the power whatever the number is. Okay, so that's something that we have with log normal, a variation. Why? Because there are chances that your initial distribution may have some, it may not be normal in a case. You convert it, you get the returns for that, and then you get into this log normal VAR. The only thing that you need to remember is there is a negative sign, because why? We are talking about the geometric returns, right? And obviously it's a negative. That's the reason we are taking e to the power that. That's the reason what we have it over here. Fair enough. Fair enough. So far, I think there was a learning objective we spoke about, spent quite a bit of time on that, but I think that really made sense. Now, moving on to the another variation, something that we have seen in level 1 as well, and that is the expected shortfall. And why do we actually use this? Okay, so expected shortfall, given either the P&L data or the return, the arithmetic or geometric return data set. How do you estimate that? It's an estimate. See, all these, it always makes sense. Okay, when you do FRM CFA, understand what the learning objective is telling you. Okay, that's the very first step, to be clear as to what they're asking. Learning objectives, they'll help you to basically, you know, if they're asking to estimate, you should know the formula. If they're asking to just explain, you should know the process. Okay, so it tells you a lot. All right, so it's talking about estimation of the expected shortfall. Let's first understand the limitations of VAR. The very first thing is that you report to your boss that, okay, $1 million is the maximum amount that we could lose. But what if a bad situation like what we are facing, you know, the stock market is just going down and down? What is a bad situation that can happen? The baddest situation. Well, in that situation, you really do not have an answer. So VAR does not tell the magnitude of the actual loss that may happen. And that's a drawback, a major drawback. That room for error for a company like LTCM, the room for error, they reported their loss, okay, around 3 standard deviations away from the mean, or I can say 0, a standard normal distribution. And reality was they had up to 8 standard deviation losses. what was their actual loss. And you know what? The LTCM, their favorite model, okay, the people behind LTCM were Nobel Prize winners. Their favorite model or their overall model reliability was on VAR. What happened? This successful hedge fund went bankrupt, like gone. Within just 4 years, they were out of business. So that's a major limitation of VAR, and we need to appreciate that. And that's the reason we appreciate the other content that we have, right? So that's one thing. And secondly, confidence level. If you select 10%, the amount will be less. If you select 1%, the amount will be more. So a variation, for example, within the industry as well, some may select 99%, some may select 99.9. Like banks, they do not want to leave a room for error, because for a bank, when they've got people's money, if they go out of business, it's going to be a systemic risk. So they calculate the VAR at 99.9% variation, okay, the value at risk. So that's the another limitations that we have. Okay, so fair enough. What we do is we know and we appreciate that, yes, there is a limitation. What can be done? Well, move on to the next risk measure or a better risk measure, and that is the expected shortfall. So the expected shortfall, or ES, it provides an estimate of the tail loss. As I said, VAR is all about the left tail, right? And risk management is all about the left tail. We don't worry about the right tails. Why? Because that's a profit situation. We never worry about profits. We worry or think about losses, right? That's what we have. Okay, so it provides you an estimate of the tail loss by averaging the VARs for increasing confidence level in the tails. No worries. There are two variations that we have for expected shortfall. The first thing is that specifically the tail mass is divided into n equal slices, and the corresponding n-1 VARs are computed. I'll give you an example. What we do is, in the normal and log normal VAR, essentially what we did is that we calculated VAR at 5%, right? That means whatever number we picked up, let's say $100 million, right? So in expected shortfall, what we do is we take the average of all these data points that we have beyond the VAR amount. Okay, so here we had a fifth largest loss. Let's say there are 100 data points. Okay, what we did is we arranged it from the largest loss till the profits and so on and so forth. And we picked up the n+1, let's say the sixth one we picked up, and we said that, okay, it's $100 million. No problem. So in order to calculate the expected shortfall, we need to take the average of all these losses, which does not include this one. Okay, so make sure it does not include this 100 million. Whatever is beyond that, the first one, the second one, the third one, the fifth, fourth, third, second, and the first loss, all these largest loss, I'll just take it up. I'll take up the amounts and I'll divide it by 5. I'll just take a simple average, arithmetic average. And this average amount is what I call my expected shortfall. Okay, so it provides an estimate of the tail loss by averaging all the value at risk for increasing confidence levels in the tail, in the left tail. That's what it does. Okay, specifically the tail mass is divided into n equal slices. Whatever the tail mass is there, we divide that into n slice, and we take n-1 so that we exclude this $100 million and we compute that. Fair enough. But then there is also a formal method of calculating the ES. Okay, and you can expect this variation on level 2. And that is the ES given some data. Like, for example, you are given a P&L data or a return data, and you're given some mean, how would you do that? Well, there is a mean out here of the distribution. Then there is a standard deviation out here. And then you make some adjustments to your numbers. Okay. So overall, you will have to, I would say that keep a safe side for it. Okay. Though I truly understand that GARP is not focusing on calculative type of questions, but yeah, this is an estimate learning objective. That is the reason I'm saying just go ahead. It's something that we have seen in level 1 as well, right? So if you just recollect, I think I would say that go with this thing. If you get it on the exam day, you don't want to feel like, okay, I did not do it. Make sure you just go through it. It's something that we have seen in level 1 as well. So just to carry forward, nothing else. So what do? We take the mean, we take the standard deviation, and we are just adjusting the standard deviation, and then we are adding it to the mean, right? There is a plus sign out here. So what are the adjustments? We take e to the negative z square divided by 2. Okay, what is this z square? This is the critical value, right? 1.65 that we calculated. So this is the critical value. We square it, we divide it by 2. And then we take a log normal kind of a thing. We take a negative value for that. And over here in the denominator, we have 1 minus x. What is 1 minus x? The same thing. 1 minus x is the confidence level. Okay. Over here, we had 5%. Over here, it's going to be 95%. And then 2 times pi. 2 times pi. So even a better way, and I've seen some candidates, what they do is, usually the expected shortfall is actually calculated, or VAR is actually calculated for VAR at 5% or maybe VAR at 1%. So even in level 1, what some candidates did is that, that there cannot be any variation, right? 2 into what is a pi? It's 3.1416. You already do this thing, right? 1 minus x, 0.95. They've remembered this particular thing. Or rather, if it's you can actually compute this entire thing. For VAR at 5%, just plug in the numbers 1.65 square, because ideally, even if you do it now or on the exam day, it's going to give you the same answer, right? So it's better. It makes sense. Extra work, but yes, you can appreciate that, okay, the ES formula is gone. So on the exam, they give you a mean of, let's say, $200 million. They give you a standard deviation of $100 million. Then this particular at 5%, it's going to be, let's say, 0.5. At 1%, it's going to be maybe 0.7, whatever the number is. So on the exam, your calculation becomes easy. The formula remembrance become easy. All you have to do is just a variation. I'm telling. All you have to do is just remember, okay, this is for 5%. This is for 1%. Because, so I hope that you're getting the point that I'm trying to convey, is remembering these things, because they're constant. They're not changing. The mean can change. The standard deviation can be any number, but ideally that's the thing. Okay. So I hope that you get the point, what I'm trying to convey. And let's talk about the first method now. Let's just suppose that we are given the 96% confidence interval VAR. We are given that information and we are told that, okay, calculate the expected shortfall. So what you do is, you actually, this is incomplete question. There was a 95% VAR that was given on the book. Okay. So what you need to do is, whatever the VAR that is given, leave that. Okay. So let's say we've got here 95% is given to us. Leave that. Take the other 96, 97, 98, 99. Take all these 4 numbers, divided by 4, add it up, divide by 4, or just rather we can say that take an average of this thing, and then this average 2.003 is your expected shortfall number. Fair enough. That's what we have over here. And there is some variation to it. If you just take the difference from this to this, you will get this as a difference. Okay. They've just taken a difference of these things, and this is a difference column right here. But there is a concept of theoretical true value And I want to spend 5 minutes on this. So what is this 2.063? What does it tell you? Right? So let's just take this one by one. All right, welcome back. So this is something that we had, and we left off at this particular thing, which is the expected shortfall. So we spoke about two methods that we had. The first one is taking the average. This is the VAR. Take the average beyond it, and that's it. That's what you actually do it. And the other thing is that you use that particular formula. And as I said, mu, standard deviation, can be different, can be any number. All you have to do is just calculate that VAR at 5%, the other thing. If you want to remember that, you can remember that. Fair enough. Now, observe that the VAR increases from the difference column. That's what we saw, in order to maintain the same interval mass of 1%, because the tails becomes thinner and thinner. Okay, so if you just observe this thing, this difference is just going up, 0.13, 0.17, 0.27, so on and so forth. That's the first observation. And the second observation is that the average of the 4 VAR is computed as this and represents the probability weighted expected tail loss. See, expected tail loss, understand, VAR is also referred to as tail loss. So if I'm talking about expected tail loss, I mean to say it's a expected shortfall. So on the, they're talking about the expected shortfall. Okay. And as the n increases, the expected shortfall will increase and approach the theoretical true value, which is 2.03 in this case. So let me just give you some numbers, okay? And if you just pay attention here to this particular chart, you would see that in the last example, what we saw is, we saw that there was a VAR that was given to us, and we took 4 slice. Okay, we just cut this. You think about this as a pizza or a cake, and you just cut that into 4 equal slices. And what was the answer? 2.03, something like that. 2.003. Okay, 003. But now, if you cut that, if there are 10 data points out here in the tail, so that means you will take 10 cuts. The answer would be 2.02. Fair enough. And if you do 25, it's going to be 2.04. And then 50, this. So as you increase the number of slices, let's say we're doing it 10,000 cuts beyond the VAR, we are on the left tail, on that side, we've come 10,000 cuts. But what is the average of all these things? The average is 2.0626. And what is the true value is this 2.0630. So as you can appreciate that, as you have more and more slices in the left tail, eventually you'll reach the true number, which should be 2.0630. This is your expected shortfall, right? We computed 2.003, the average of all the values, but essentially it should turn out to be 2.0630. And if you increase the n, as you can see here, the slices, you reach true value, or ideally the value should be around that. Okay, so that's what they've given over here, the true value, and we need to appreciate, okay, where does it come from? Fair enough. Now that's the difference columns, that's the value at risk column, all the VAR, and these are the confidence level that you have given.
So this theoretical true value is when the slices approaches towards infinity, like we'll have infinite slices.
Yes. See, that's what the thing is. If you look at the normal Z table, okay, you get, for example, a positive cumulative Z table. You have from 0, you have 1 to, this is 1 standard deviation, you have 2 standard deviation and 3 standard deviation, right? You do not have anything it goes beyond that. And if you have a negative table, you do not have a negative or beyond this -3. But ideally, theoretically, see, that's what we are saying theoretically, right? It goes to positive and negative infinity. But we just take a limit, just what we have in calculus, we take a limit, okay, that it goes beyond that. And even in the Z table, you will just see up to 3, nothing beyond that. But ideally, yes, as you cut the end slices, it's going to reach to a true value that ideally should have been. So that's the point.
Do we need to calculate this theoretical true value, or like we'll get something on this?
No. We don't have to calculate this theoretical true value. This is just for your understanding that, okay, where does this true value comes from? And we see the learning objective, it talks about expected shortfall. So ideally, you should be good in calculating the expected shortfall via this method. If it comes up, you're given the mean and the standard deviation. So what would you do? How would you calculate? So this is the formula. You should be comfortable in that. And secondly, you should be comfortable in this, taking out the average beyond the VAR. These two methods, that's what the learning objective, the focus is on these two methods. This is just the additional information that if you revise from the book next time, you should not be confused. Okay, what is theoretical true value? That's the thought process. Okay. Yeah, fair enough. Okay, so we've got these things out here, and this is the thing that I've taken from the curriculum. And okay, moving on to the next learning objective, which says estimate risk measures by estimating the quantiles. Now, first of all, this quantile, if you are ever confused with all these things, let me clarify. Quantile is a mathematical term. That means you've got this distribution. Okay. Each of these bar, they represent something. Each of these blue bars that you see here, you can consider that they are different quantiles. Okay. If you have a distribution of anything, and if you divide this distribution into 4 quantiles, okay, or rather we say that it becomes quartile, just like we see the results for the FRM, they give you in quartiles, right? So that means you've got 4 quantiles. I can divide this distribution into 4 equal parts. Similarly, if I divide that into 100 quantiles, I can say that it's not a quartile anymore, it's percentiles. That means I got to divide this entire distribution into 100 equal parts, so that each stick or this bin is, reflective of 100 parts. That's what we mean by that. Now, why are we talking about this quantiles over here? The reason is very simple. You calculate the expected shortfall, which we said that, okay, it's better than value at risk. We appreciate that, yes, value at risk is not good, but we then, said, okay, let's calculate the expected shortfall. But the problem with the expected shortfall is that you are giving equal weight to all these losses, which is beyond this VAR. You are giving equal weight. So essentially, I can say that maybe you are not concerned about this loss, which is even onto the extreme side of the tail. And you've given 10% weight to this, as well as 10% weight to this particular loss. Now, does that make sense? Think about it very logically. As an investor, will you give the same weight to this particular bar and this particular bar? No, right?
No, sir.
Obviously. Yeah, go ahead.
No, sir, I'm not giving the same weight.
So obviously, what would you do is, you would, if this is 10%, you get a higher loss, I'll give a more weight to this 12%. Maybe higher loss, I'll give a 15%, maybe 25%. Oh, it's an extreme one. Give it a 50% weightage to this. So that is the thought process. that by quantiles, you can go ahead and you can make that conversion from the expected shortfall. You're moving on from the expected shortfall and you're doing a better version of it. And that's better version is what we say is the estimating by quantiles. Or actually, there was a learning objective which has been removed for 2023, and there was a coherent risk measure. Okay, so a risk measure, if you want to call that a coherent risk measure, it should not behave like, okay, give equal weightage to all these tails. No, they are the losses. They are extreme losses. In order to be coherent, you've got to give the weight as per your risk appetite, risk aversion. And over here, that's the reason expected shortfall is not a coherent risk measure. But over here, look at this particular thing or this distribution. You will decide as an analyst whether you want to give weights to this or you want to give just 0.01% weight to the first one. Maybe around the mean, you want to give, let's say, 0.02% weight. And as you move to the losses side, you start increasing, okay, 1%, 2%, 3% weight, so on and so forth. So the average that you're taking, it's going to be a weighted average. In expected shortfall, what we did, we just take simple, okay, there were 4 data points. The VAR was $100, $102 or $105. We just take a simple average, okay, divide by 3. No. In this quantile method, you will, as per the weights that you've assigned, then you will, okay, 1% for 100, okay, 2% for this 102. So you will take that expectation. Remember in quants, we used to do the expectation of something. We had the probability and the values x1, then the second probability, the second value, third probability, third value. So it's like a weighted average that you would do for all these tails according to your thought process, according to your risk appetite and risk aversion. That's what this entire learning objective talks about. Make sense? That's the risk measures by estimating the quantiles. Now you can divide that entire quantile up to 100 parts, whatever that you want to do it. But each quantile that you take, okay, each quantile, you can assign a weight to it. And that is what the thought process is. So that is why we say that expected shortfall is not a coherent risk measure in terms of giving weights. Okay. Now they've not given clearly what coherent risk measure is. They've not clearly defined that, but we take it as a given that, okay, this is something that we have, and this is something that what we need to focus on. All right, moving on to the next learning objective, and that is the standard errors and evaluate the estimators of risk measures by estimating their standard errors. Now, what is a standard error? Okay, let's just say that you are reporting the value at risk to the management. Now, are you 100% sure about that value at risk number? Let's say the VAR that you reported is $1 million. Are you 100% sure about that? Or maybe you want to get a range, like, okay, it can range from, if not 1 million, it can range from $950,000 to maybe $1.5 million. So what is this range? This range is what we say is confidence interval. It's an interval, right? Like the credit scores that we have, right? The credit score, the CIBIL scores, they've got a range from 300 to 900. And within this range, the people, their score will come up.